A very good afternoon to you, grade 12 learners. My name is Mr. Simbi, and welcome to today's accounting lesson. This lesson is brought to you by the Gauteng Department of Education in collaboration with Sabono Discovery Center. I know it has been like forever since I last saw you, but it was just 1 week when I missed you when we had the holiday. And I know that you're back at school, and I hope that you are studying because our countdown for the June exam has already begun. The June exam is around the corner, and I need you to be studying. I need you to commit to your books. I need you to spend time practicing on accounting questions. On this page, on this platform, we have done several topics already. We've done the statement of comprehensive income. We've done the statement of financial position, and we're able to do this two together when having one adjustment, and we're able to see how do I adjust it in the statement of comprehensive income as well as the statement of financial position. We did the cash flow statement as well on this very same classroom. So if you need help with the statement of comprehensive income, statement of financial position, and the cash flow statement, please do go and watch the lessons. And then in today's class, I'm going to be focusing on analysis and interpretation of financial information. In the previous class, that is the week before the previous one, I also did the cash flow statement and I did calculations of certain financial indicators, but I did not get deeper into the analysis. When we get this figure, what does that mean? And that is what I want to do with you today. Now, here are my objectives. I'm going to be doing the analysis and interpretation of financial information. There is a worksheet that has already been sent to your teacher. So please do speak to your teacher. Remind your teacher to send you this worksheet. If the teacher is not able to print it, they can send it to you electronically and you can have it on your cell phone so that when I'm explaining certain figures here, you can see it on your cell phone and you can make sense out of that. So I need you to have your calculator, you need to have somewhere to write, and you need to have that particular worksheet, which I have already sent early in the morning today. If you're ready, can I see those thumbs up? Then we can start with today's class. Once again, welcome to our accounting lesson. When we talk about the analysis and interpretation of financial information, it is very important that we understand that we're going to need some statements to analyze as well. We're going to be looking at the statement of comprehensive income and the statement of financial position. And you can go back to the previous lesson that I did when we also had the cash flow statement and we're able to analyze certain information out of that cash flow statement. And here are some financial indicators formula. You understand by now that at the back of your question paper is the formula sheet. But I want to emphasize, you need to know your formula sheet by heart. You need to know it. It has to be in the fingertips, that when you close your eyes, you can see this formula sheet. That becomes easy for you to tell which formula can I use where and how do I apply that particular formula. So here what you can see, I have my profitability, financial indicators. And these ones come from the statement of comprehensive income. And we have the solvency ratio. In today's class, I'm going to do this one as well, and I'm going to comment on it. It simply looks at the ability of a company paying its total liabilities using its total assets. And then we can say, is a company solvent or not? And that is what we're going to be doing in today's class. Okay. And then the formula sheet is attached in a SIP material, session 9 to 20. So the SIP material that has already been distributed here in Gauteng. And when you go to that SIP material, you'll find this formula sheet is attached, that is in session 9 up until session 20. And then we talk to liquidity financial indicators, the ability of a business to settle its short-term obligations. Are we able to pay our short-term debts? That now is liquidity. And we have our liquidity financial indicators, as you can see. And then we have our return financial indicators. That is when an investor, when a shareholder has put his money into the company, what do they get in return? So we have our return financial indicators as well. And then we continue with our return financial indicators. And a very interesting financial one is the risk or gearing financial indicators. financial risk or gearing. And here we're looking at the debt equity. And in today's class again, I'm going to be emphasizing on this particular one. And so this is what you would find at the back of the question paper now. And what I did here is to try to show you which financial indicator is where and to which family of financial indicators does it belong to. So you see from what I have here at the top here is your profitability financial indicators. And then here you're going to have your liquidity, and just beneath it is your debt equity. And your solvency is up here at the top, and these two speak to your acid test ratio. And these ones are tested in both paper 1 and paper 2 as well. The same with these financial indicators. And here we're talking liquidity financial indicators. And most exam papers instruct learners to use the closing stock. So you need to be very careful. And you'll see as we go, there are certain times where you can be asked by the examiner to use the closing stock, but at times you use the average stock. So you have to be very certain. What is the examiner asking me? Is the examiner asking me to use the closing stock, or the examiner is asking me to use the average stock? Do not assume. Do not assume. Understand the demands of the examiner, and then you do as the examiner has instructed you to do. And here you then find your return financial indicators, and then you find your break even. That is for paper 2. I'm going to leave this one as we do cost accounting. I'm going to come back to it, and then we have a deeper look into it. Okay, so to begin with now, we're going to do activity number 1. Now, activity number 1, I've extracted it from the DBE prelim paper for the year 2022. So, as I said earlier on, this paper was sent already to your school. Please do talk to your teacher, and then they will assist you with this particular activity, because it has already been distributed. And if you have it, then let the games begin. Okay, so it begins and it says, interpretation of financial statements. Solar Style Limited. That's the name of the company. And it reads, you are provided with the information of Solar Style Limited for the financial year ended 29 February 2020. Very key. Remember, in the first 10 minutes of your examination, you are given time to read and understand. And remember, we read the question paper in hand with the answer book. So we need to understand this too. And then it continues. The business provides solar panels to households to supplement their electricity supply. Note, provide figures. So whenever we are going to be analyzing, we have to provide figures, financial indicators, or calculations, in each case to support your comments. So I have to make comments, and I also need to make explanations. And I'll need figures, financial indicators, and calculations as I support my comments together with my explanations. Okay, let's go and see what is the first question. So the first question is a combination of 2 questions. It is solvency and liquidity. Solvency and liquidity. Is there a difference between the two? Solvency and liquidity. Remember what we said solvency is: the ability of a business to settle all its obligations. In other words, the ability of our total assets to pay off our total liabilities. That is solvency. All right? And then it tells us whether a company is solvent or not. Now, if you come and look at this question, the examiner did not give us the solvency ratio, but instead the examiner gave us total assets to total liabilities. So you could have gone through all the financial indicators looking for the name solvency, and you would not have found it because the examiner did not put the name solvency. The examiner simply put the formula, which is the total assets to total liabilities. So it is very important that you know the name and you know the formula, because in the event that the name is not given and you're given the formula, you can still tell that is my solvency ratio. And here we are given the solvency ratio, which is total assets as to total liabilities. And remember, we count our financial information from the right going on to the left. That is from 2019 until 2020. So, what do we see here? Let us comment then. It then says, you can see here we have 5.0 S to 1, and here it's 2.0 S to 1. And all of this is talking to the degree of solvency. What it means in 2019 is, for every 1 rand of liabilities, the company had 5 rand of total assets to pay. So the company was solvent in 2019. And when we come to 2020, for every 1 rand of total liabilities, the company has 2 rand of total assets. That's what it means. The company is still much solvent. Now, but what we need to do is to comment. First, I need to have the name. Then I'll say, the solvency ratio has decreased. The solvency ratio has decreased from 5.0 S to 1 to 2.0 S to 1. In other words, the solvency ratio has decreased by 3.0 S to 1. Okay, so this is what I do first. So when I have the solvency ratio, this is the financial indicator. Okay, so I must have the name, that is number 1. Number 2, I must have the trend. Trend is increase, decrease, improved, declined, deteriorated. That's the trend. So here I have the second one, which is the trend. Name, trend, and then I also have my figures, which is number 3 here. And then I'm saying the solvency ratio has decreased from 5.0 S to 1 to 2.0 S to 1. Okay, what does this mean then? Because this is my analysis. Here I've analyzed, I've looked at the figures, what has happened to the figures. Now I need to comment, what does this mean? I would then say, although the solvency ratio, I can just say the solvency has declined. Although the solvency has declined, the business is still solvent. Although the solvency ratio has declined, the business is still solvent. We're saying it has declined from 5.0 S to 1 to 2.0 S to 1. Even though it has declined, we are still able to pay our total liabilities using our total assets, because the financial indicator is now 2.0 S to 1. It has declined, but the business is still solvent nonetheless. So what I've done here, I have done 1.1.1, where I've commented on the solvency, and I've caught one financial indicator. What was that financial indicator? The solvency ratio. And I needed to have the trend as well as the figures. And then I brought in my comment over there. That is what I expect you to do in the June exam. Are we still together? Okay, let's see the second part of it now. Remember, we've dealt with the solvency. Now I need to go to the liquidity. Let's see if we can do the liquidity. Okay, here we go. What is liquidity? Liquidity is simply the ability of a business to pay its short-term obligations. Okay, are we able to pay our short-term obligations using our current assets? That's liquidity. Okay, so the question says, explain why the directors are satisfied with the change. So we are being told that the directors are satisfied. So you must be exposed to such type of questions. A different question can come and say, should the directors be satisfied? In this question, it is not asking us. We are not being asked if the directors should be satisfied. Rather, we are being told that the directors are satisfied with the change in the liquidity of the company. And we need to quote two financial indicators with figures. Now, you need to note that under normal exam conditions, most exam papers will give more liquidity indicators. So you would find that you would have your current ratio, you would have your credit payment period. All these financial indicators can still be provided. But in this case, we were only provided with these two. And I specifically extracted only these two because I need to comment on these two. Okay, so can we begin? Let's start with the first one. We'll now say the acid test ratio. Let's come with the acid test ratio first. In 2019, the acid test ratio was 2.6:1. And in 2020, the acid test ratio became 0.8:1. What did we see over there? We can say the acid test ratio, we can say the acid test ratio is now efficient. It is now efficient. Remember, it was 2.6:1, now it's 0.8:1. I'm going to explain. It's now efficient at 0.8:1. Whereas it was too high. It was too high. It was too high. Right? It was too high. Okay, let me write that again. It was too high when it was at 2.6:1. At 2.6:1 in 2019. Okay, what does that mean? With the acid test ratio, we're looking at our ability to pay our current liabilities, but not involving stock in it. In other words, we're only looking at note number 5, trade under the receivables, and note number 6, cash and cash equivalents. When we look at those two, our trade under the receivables and our cash and cash equivalents, are they able to pay our current liabilities? And you see that in 2019, we had 2.60 of our trade under the receivables and our cash and cash equivalents to pay R1 of current liabilities. So the question then is, why would you need 2.60 to pay R1? Is it not wise to have R1 because you need to pay R1? That's why you see I'm now saying, having 2.60, we were having more to pay only the R1. But now it is now at 0.8. We consider it more efficient in this case. Whereas in the previous year, 2019, it was too high. All right. So we now say the acid test ratio is now efficient at 0.8:1, whereas it was too high at 2.6:1 in 2019. Why do we say it is now efficient at 0.8:1? It simply means we are now having more productive use. The company now has more productive use of cash resources. There is now more productive use of cash resources. We are now using our cash productively. We are not just keeping stock lying in the business. The cash is being used more productively in the business. Okay, so there is more productive use of cash resources, or we can say of our liquid assets, cash resources, or we can say of our liquid we can say of our liquid assets, or we can say more productive use of working capital. More productive use of working capital. This is what we now have. So 0.8 is more efficient than the 2.6 S21. Let me go on now to the second financial indicator, which is our stock turnover rate. The stock turnover rate simply means how many times do we go buy stock, come sell it, and then we go buy stock again, come sell it 2 times now, go buy stock again and sell it 3 times now. So in the previous year, we did that 3 times. Buy stock, sell it, buy stock, sell it, buy stock, sell it 3 times. In 2020 now, we did that 6 times. That is good. When the stock turnover rate has increased, that's a good indicator. So we can now say this was number 1. I'm coming now to number 2. I'll now say the stock turnover rate, the stock turnover rate has improved. It has improved from 3 times to 6 times. The stock turnover rate has improved from 3 times to 6 times. What does that mean? It means this indicates that stock is being sold, more quickly now. We are selling our stock more quickly in 2020 than in 2019. That is good for our liquidity position. Okay, dear learners, I'm going to take a 2-minute break and I'm going to see you in exactly 2 minutes. And welcome back. Before the break, we did the solvency financial indicator as well as the liquidity financial indicators. In the liquidity, we looked at our asset test ratio and we realized that 2.6 is not efficient. It is too high, but 0.8 is efficient, and it shows that there is proper and more productive use of our liquid assets. That is proper use of our working capital. And we looked at the stock turnover rate and we realized that when it is 3 times, it is low because we went to buy stock we sold one time. We went to buy stock, we sold two times. We went to buy stock, we sold three times. But if we do it more frequently, therefore it becomes more productive. And it indicates that our stock is now moving more quickly. And you have to remember that stock and cash move in opposite direction. So the more we do that, the more cash is coming into the business. So it becomes a good liquidity position. Can I move on to the next one now? Let's do so. Let's go on to the next question. Next question is 1.2, and we have 1.2.1. 1.2.1. And it says, comment on the percentage return and earnings per share of the company. Quote two financial indicators with figures. Okay, so when we come to our percentage return and earnings per share of the company, it is very important to understand that when shareholders invest their money in a company, they're doing it so for the return. They bring in the capital, expecting a return. And that is what we want to look at now when we look at the percentage return and earnings per share of the company. So to begin that, we're going to look at this one. First, number one, we're going to look at the return on shareholders' equity. The return on shareholders' equity. So, on our share, we see that the Rocher, remember that is the name, it was 8.7 here in 2019. Now it is 5.3. That is a decline. It has deteriorated. It has gone down. So we then say the Rocher has declined. The Rocher has declined from 8.7%. Okay, it has declined from 8.7% to 5.3%. To 5.3%. That is point number one. So our share has declined from 8.7% to 5.3%. Okay, so in the next week's lesson, I'm going to show you how to calculate increase or decrease in percentages now. In today, I just want to do increase or decrease from to. In next session, I'm going to do that calculation of increase or decrease by a particular percentage. So here it has declined from 8.7 to 5.3%. So once your share has declined like that, it is not a good position. It is not a good position. Okay, so this is my point number one. We're commenting on the Rocher. My point number two, let me come to point number two. My point number two is when we now say, if I am a shareholder, I'm an investor, I would go for an investment which gives me a higher return. So whenever I look at my Rocher, I'll think, if this shareholder did not put their money in this particular company, in our company, where else would they have gone? They would have gone to other financial institutions where they would have invested. So we look at what we call alternative investments. You'd find that other question papers will actually state alternative investments. But in this one, it says interest rate on investments. We're talking things such as your fixed deposits, where you can take your money to companies, financial institutions, such as banks, where you can invest your money in a fixed deposit. So you have two options, either to bring the money into our company, or you take the money onto a financial institution and invest it as a fixed deposit. Here is two things now. The fact that you brought the money into the company, you'd get 5.3%. That is 5.30 per every 100 Rand invested. But if you had taken it to other institutions and you had put it in a fixed deposit, you would have got 6.5%. That is 6.50 Rand for every 100 Rand invested. That simply means if you were taking your money to alternative investments, you would have been getting a higher return. So you now have to now say your Rocher versus your alternative investments. Let's now say the Rocher of 5.3% the ROCE of 5.3% is lower than the return on alternative investments, and the return on, I'm going to use a capital A here, on alternative investments. On alternative investments. And these alternative investments are giving 6.5%. So it simply means the return in this particular company is lower than what alternative investments are giving. If our share was higher, then alternative investments would have confidence in the return that we're giving to our investors. But in this case, we are not giving our investors a good return because we have other alternative investments which would give a higher return in this particular case. We're still together? Okay. So far I've commented on my ROCE. I've commented on my ROCE. The next one that I want to speak to is my earnings per share, EPS, earnings. When you talk about earnings per share, you are saying after you have calculated your net profit, remember you still have to pay tax, then you take out your tax, income tax, and then you remain with what we call net profit after tax. And that one now is what belongs to the shareholders. If we divide that by the number of shares that the company has in issue at that particular time, we get our earnings per share. What has each share in the company earned? What has each share in the company earned? That is, they're simply sharing the net profit after tax. So you will see that in this case, in 2019, the earnings per share, what each share was earning, was 96 cents. But if you come now to 2020, that has declined, deteriorated. It has gone down to 72%, 72 cents, 72 cents. So I'll then come here and I'll now say, my third point is, my earnings per share, my EPS, has declined. Has declined from, it has declined from 96 cents to 72 cents. My earnings per share has declined from 96 cents to 72 cents. In other words, it has declined by, so if I take the difference here, let's see if I can find my adding machine, not a problem. Okay, so it has declined. If I say 96 minus 72, that will give you 24. It has declined by 24 cents. Okay, it has declined by 24 cents. What does that mean? This, in a way, points to a decline. This indicates a decline. This indicates a decline in the company's profitability. It indicates a decline in the companies because whatever net profit that we're now sharing, it is now lesser than what we were sharing in the previous year, having maintained the same number of shares. If we maintain the same number of shares, that means the profit is now declined. That is, when there is no change in the share capital, that would indicate a decline in profitability. So when I spoke about the return, I spoke to two things. I spoke to the ROCE, and I also spoke to the ROCE versus alternative investments. And when I spoke on earnings, I went straight to my earnings per share, which you see has declined from 96 cents to 72 cents. That is not a good thing. And you see that when your earnings decline, it will have a negative impact on the company because potential investors will look at the earnings that they would stand to get when they come into the company. Higher earnings means the company is more lucrative. People would want to be part of this company that is giving higher earnings. So you can see here we have a decline in earnings, and we are going to see an impact on the company due to the decline in the earnings per share. In today's class, I'm going to wait on these 2 points. I'm not going to go further, but in our next class, I'll also bring in other points. So here I spoke to ROCE alone, a decline. Second one, Rocher versus alternative investments. What we're giving as a company against what other investment opportunities would have given our investors. And then we looked at earnings per share, which has declined. So I looked at those points there. I'm going to move on now to the next aspect. And it reads, comment on the share price on the JSE and how the percentage return and earnings per share have affected the share price. Okay, so as a company, you understand and you know by now that we issue our shares on the JSE, all right? And then we have what we call the market price. Market price simply means what we are currently selling our shares for or at. How much are we issuing one share to the public at? And you will see that in the year 2019, our market price per share was 920 cents. And then in 2020, you can see that that market price has dropped. It has declined. It has deteriorated to 840 cents. That's 8.40. That's very important to note. But now the examiner is saying, we need to comment on this share price, that the share price is declining. But we also need to state how the percentage return and earnings per share have affected the share price. So the examiner is trying to say, look at your earnings per share, and then you tell us how the change in the earnings per share could have impacted on the market price per share. Okay, so remember what we said earlier on. Earlier on, we did say that our earnings per share has declined. So when there is a decline in earnings per share, it means most of the potential investors will not be interested anymore because they see a downward trend. They see a decrease in earnings. Investors come for good earnings. So once they see a downward trend on earnings, they become less interested. That means there is less demand. Less demand for shares leads to a drop in the market price per share then. You see the link now. So there has to be a sequence. We want to put that into words. Let's see. So we say the decline in earnings per share. The decline in earnings per share from, I can say that again, from 96 cents to 72 cents in 2020. In 2020 has led to a decline in the market price, per share from 920 cents to 840 cents. Okay, so in this case, it has declined by 80 cents. The difference between 920 and 840, it has declined by 80 cents. Okay, so we can see here our market price per share has declined by 80 cents. What does this mean? This means there is a drop. There is a drop or a decline. There is deterioration when we look at the demand for shares. There is a drop in demand. There is a drop in demand. There's a drop in demand for shares. There's a drop in demand for shares. There's a drop in demand for shares. It simply means our investors are now not confident. So that can be put in simple ways to say there is low investor confidence. There is low investor confidence. There is low investor confidence in this case there is low investor confidence. Okay, so that is point number one here. But the next thing that we can also look at, so this would be number one, when we looked at the change in the EPS and how it led to a decrease in the market price per share. Okay, so let's also look at another indicator. Here we're going to look at our net asset value per share, and then we compare it again to the market price. So the net asset value per share, we have calculated this in this class when we looked at our shareholders' equity and we divided by the number of shares. So it is the net asset. In other words, we're saying what is the value per share, the actual value that we have attached to our shares. So if we look at 2019, you can see that our NAV was 920, but in 2020, our NAV was 912 rather. It was 912, but now it is 877. But our main emphasis now is to compare these two. It is to compare these two to say the value at which we have valued our shares, or the value that we've attached to our shares according to how much they are worth, it is 877 cents. However, we are selling these shares at 840 cents. So in other words, we are issuing shares that are worth 877 and we're issuing them to the public at 840, lower than their net asset value. So we'll now say the market price of 840 cents, the market price of 840 cents is lower than the NAV of 877 cents. The market price of 840 cents is lower than the NAV of 877 cents. All right, and if I take the difference here, I'll just say by 37 cents. By 37 cents. It is lower by 37 cents. So this also tells me, when I comment now, this indicates a decline in demand. This indicates a decline in demand. There is a drop in the demand of our shares. That's what that simply means. There is a drop in the demand of our shares. Okay, dear learners, we're going to take again another short 2-minute break, exactly 2 minutes, and then I see you in 2 minutes. Welcome back. Before the ad break, we looked at our earnings, returns, and share price on the JSE. Okay, so I'm going to move on from here and we're going to go on and look at the next question. Gearing. And it says, explain how the loan affected the risk and gearing and whether it was a good idea to increase the loan. Quote to financial indicators with figures. Okay, let's look at this nicely. In 2019, we had a loan of 2 million. There is the 2 million. And in 2020, you can see the loan is now 3.5 million. That means we've increased the loan by 1.5 million. Now, when that has happened, it will then affect risk. And when I hear the word risk, I quickly think debt equity. I think debt equity. What is the relationship between my debt and my equity? Am I able to settle my debts using my equity? Okay. And what proportion of debt is in the equity? That is very, very important. Debt equity. Then I look at my risk. So having increased from 2 million to 3.5 million, I now need to look at, is risk increased or risk is now low? So let's go and look. Debt equity ratio. When the loan was 2 million, it was 0.3:1. This was low risk. And we increased the loan by 1.5. Now we're sitting at 3.5 million. And it is 0.4:1. It is still low risk. So I can then say the debt equity ratio, the debt equity, this is the financial indicator. The debt equity ratio has increased. From 0.3:1 to 0.4:1. In other words, it has increased by 0.1:1 in simple words. And then now, was it a good idea? Then we're going to go and look at that. Has the financial risk increased? Yes, the financial risk has increased in this case because it was 0.3 to 0.4, but however, it's still low. It has increased, but it is still low. So we can say the financial risk has increased. Okay, the financial risk has increased because your debt equity ratio has increased. Now, I want to come and look at the second one, and then we're going to come back again to this one. The next question says, and gearing, and we should state whether it was a good idea to increase the loan. Now, when we look at gearing, we are simply saying, when we got the loan, remember a loan is a form of finance. Hence, when we're in the cash flow statement, when we talk about finance, we look at two things: own finance, borrowed finance. Own finance, shares. Borrowed finance, loans. And with borrowed finance, there is risk. And we also have what we call finance cost. In simple words, we say interest. That is finance cost. So when you take a loan to invest it, because when we take a loan to invest it so that that investment can give us a return. Can I say it again? Okay, let me say it again. We don't take a loan to pay for operating expenses. We take a loan to finance an investment. We get? So we take a loan so that we can finance an investment. And that particular investment must give us a return. We're together now. So if we are to see whether it was worth it getting the loan, we need to compare the return we get from the investment against what we are paying as finance cost. So let's look at the first thing now. When we talk about the return we get from the investment, we're looking at our ROTCE, return on total capital employed. Total capital employed. So we take our capital, we employ it, we put it to work. And when it works, it gives us a return. And the return it's giving us is 6.2. And you can see there's a decline from 11.6. We're still together. So I can come and say now, on my second point, that the ROTCE has decreased from 11.6% to 6.2%. It has decreased. The ROTCE has decreased or deteriorated or declined from 11.6 to 6.2%. That is point number one. That is point number one here. Point number two then becomes, this ROTCE has declined, but if I look at what I'm getting from this investment, when I take the loan, I finance an investment. We buy equipment, we buy machinery, and we operate. The return that I then get, that's my ROTCE. So I must now say, my ROTCE is giving me 6.2%, that is 6.20 Rand per 100 Rand. So it's giving me 6.2. From what it is giving me, I must be able to cover my finance cost. And I then bring my interest now. I then bring my interest on loans. And my interest is 10.2, 10.5, 10.5. So I'll now say, if I take a loan, for example, I take 100 Rand loan. On that 100 Rand loan, I'm going to pay 10 Rand 50 as interest. I take 100 Rand loan and I'm going to pay 10 Rand 50 as interest. On that 100 Rand that I've taken, I finance an investment. And what that investment is now giving me as a return is 6.20 Rand for every 100 Rand that I've invested. So I must be able to take that return and subtract the interest, the finance cost. And let's see what I get. In this case, I'll now say 6.2 minus 10.5. And it gives me a negative 4.3. All right, so it gives me a negative 4.3. So I'll come here and then I'll say it is a negative 4.3. What does that mean? It means from what I get as a return, it cannot even cover the finance cost. So we are negatively geared. We call it negative gearing. Negative gearing. When our return cannot even cover the finance cost. Should we have borrowed that loan? No. Was it a good idea to increase the loan? No, it was not a good idea. Okay, so we say the business is experiencing negative gearing. The business is experiencing negative gearing. The business is experiencing negative gearing. Therefore, it means it was not a good idea to increase the loan. It was not a good idea. It was not a good idea to increase the loan. To increase the loan. It was not a good idea to increase the loan because we are negatively geared. So I looked at a number of points here. First, I looked at the debt equity ratio having increased from 0.3 to 0.1. And we realized that even though risk is still low, but it has increased from 0.3 to 0.4. And then we looked at the ROTCE, the return on total capital employed, having decreased from 11.6 to 6.2 here. That is also not a good indication. It simply means the company is not fully utilizing its capital resources. And then we then realized that the company is negatively geared because the ROTCE of 6.2 cannot cover the interest on loans of 10.5. Therefore, it was not a good idea to increase the loan in this case. Okay, I hope this has answered a lot of questions that you had. I'm going to move on to the next question now, which is 1.4. 1.4 says, refer to information D. The directors decided to offer existing shareholders. So here we're now looking at major shareholding now, major shareholding. The directors decided to offer existing shareholders 1 share for every 5 shares they own on 1 September at a price of 6.50 Rand each. Alan Butter, I'm here now. Alan Butter currently owns 45% of the shares of Solar Style. Alan was one of the new shareholders who decided to accept this offer. Explain how Alan's decision affected his percentage shareholding. Provide a calculation to support your explanation. Okay, let's have the calculators ready. So we want to see now if Alan is going to buy 1 of every 5 shares. How many shares does Alan currently have? He currently has 360,000 shares. So we come in and we say, of the 360,000 shares that he currently has, we divide that by 5, like that. Okay, let's see. So we're going to say 360,000, like that. Let's divide that by 5. That's going to give us 72,000. That means Alan is going to buy 72,000 shares. Okay, so if Alan is going to buy 72,000 shares, it simply means we're going to now say the 360 that he already has plus the 72,000 that is now going to buy. How many shares is Alan now going to have? Plus the 360. 432,000. It's going to be 432,000 shares that Alan is now going to have. And if now Alan has 432,000 shares, at the end of the year, here on 29 February 2020, there is 900,000 shares in issue. So what percentage is that going to be now? So we then say, the 432 that he holds, what percentage is it of the 900? What percentage is the 432 to the 900? So it will be 432 divided by the 900,000 shares. That gives us 48%. That means Alan has now increased from the 45 to 48. Okay, let's comment. Alan's percentage shareholding, Alan's percentage shareholding has increased / improved from, okay, it has improved from what? It has improved from 45% to 48%. I said in today's class, I'm just going to talk of percentages from and to. In the next class, that's when I'm going to show you how to calculate the percentage increased from 45 to 48. So here it is improved from 45 to 48. That's all. Explain how Alan's decision has affected his percentage shareholding. His percentage shareholding has increased, or it has improved from 45 to 48%, and provide a calculation. Here is our calculation. That was the first part of the question. Remember, he had 45, now he has 48. Okay, and if you want to add, he is still not a major shareholder, because in order to be a major shareholder, I always teach the 51% is much safer. You need to have 51% of the shares in issue to become a majority shareholder. So in this case, he is still not the majority shareholder. Okay, let's go on to the next question and see. Give 2 reasons why Alan might have made this decision. Why would Alan go and buy these 72,000 shares? Why would Alan buy these 72,000 shares? Number 1, what price did Alan pay? Alan has been offered to buy the shares at 650. But this is the same price that he paid when? In the past. Are we together? In 2019. Okay. And if you go and see, in 2015, when he bought the shares, he bought them again at 650. All right. So that would have been another point for Alan. Okay, that when he bought the shares in 2015, he had paid the same 6 Rand 50. Okay, so we would say point number 1, that Alan has paid 6 Rand 50, which is the same price, paid in 2015. Okay, so that's an advantage to Alan there. The next point, if he is going to pay 6 Rand 50, I would want to believe he's going to benefit, because he plans probably to become a major shareholder. All right, so he plans to become a major shareholder, to become a majority shareholder, a major shareholder. He plans to become a major shareholder. So if he purchases more shares, and then he can achieve that, and then that simply means he can now be able to influence decision making. He can now be able to influence decision making. You can be able to influence decision making in the future. Okay, so this is another point that we can say he is buying the shares because he wants to support the recovery plan of the company, because he wants to support the recovery plan, to support the recovery plan of the company. He wants to support the recovery plan of the company. He wants to see the company going up and doing well again. Or he sees potential in the company. So that is why he has decided to buy more shares. Okay, I'm going to go on to the next question, which is now 1.5. And it reads, one of the directors feels that the dividend payout rate should have remained constant. Give one possible reason with figures. So here they never told us constant at what. That means in 2019, there was a dividend payout rate that was there. So we need to go and calculate the dividend payout rate in 2019. So we need now to see, how do we calculate the dividend payout rate? It is your DPS over your EPS. You multiply that by 100/1. So in 2019, our DPS was 48, and we divide that by 96. I multiply by 100/1. And if I come here, it means I'll say 48 divide by 96. That is going to give me 50%. So here it is 50%. My dividend payout rate is 50% in 2019. So one of the directors feels that it should have been maintained at 50%. The dividend payout rate, we should have maintained it at 50%. What evidence is there that it has changed? That means now we need to come to 2020 and check what has happened in 2020. In 2020, it has changed because we have still given the 48 cents, but you can see that your earnings per share has declined to 72. So it is 48 over 72. We multiply that by 100 over 1. Let's see. So we come here and then we say 48 divided by 72. That gives me, I multiply by 100. And that will give me 66.7%. So let's just call it 67%. Okay. So it has gone to 66.7%. Okay. 67%. Now, the question then is, one of the directors feels that the dividend payout rate should have remained constant at this 50%. And you can see that it has been increased from 50% to 66.7%. Give one possible reason why one of these directors feel we should have kept it at 50% and not increase it to 66.7%. Why does he feel like that? Number one, if we look at our earnings per share, it was 96%, it is now 72%. So we can see that now our EPS has decreased. Our EPS has decreased from 96 cents to 72 cents. Okay, not percent, cents. So our EPS has decreased from 96 cents to 72 cents. Yet the DPS, you can see the dividend per share has remained at 48. Yet the DPS has remained constant. Constant at 48 cents. Our DPS has remained constant at 48 cents. This is why it has increased. This is why it has increased the dividend pay out rate. Let me write it in full. Dividend payout rate. Okay, just write dividend payout rate. It has increased the dividend payout rate from 50% to 66.7%. That is my point number one. He feels that we should have maintained it at 50% because our earnings per share has declined, yet we maintained the same DPS. This has now led to an increase from 50 to 66.6%. Let me go to B. Let me go to B and explain from a different perspective now. Okay. Remember what we do with our dividend payout rate. Whatever is not given is maintained. Let me make this simple illustration. If, as shareholders, if you earn 100 cents, okay, let me use the figures that we already have here. If you earn 96 cents and you are given a dividend of 48 cents, that means the company has retained 48 cents. So, in 2019, the company was able to retain 50% of its earnings because it gave 50% of its earnings as dividends. Therefore, it retained 50% of its earnings. But in 2020, the company gave 66.79 which is maybe 67% of its earnings as dividends. That means it only retained about 33%. So if the dividend payout rate, had remained constant, at 50%, the company would have retained, the company would have retained 50% of its earnings. 50% of its earnings. Instead, it retained, in this year, it retained 33%. In this year, it retained 33%. You can say 33.3%. 33.3%. In this year, it has retained 33.3%. That is why this director feels we should have maintained it at 50%. If we retain, we look at future expansion. If we retain, we look at future expansion and growth. We look at future expansion and growth of the business. So in this case, we only retained 33.3%. That is taken away from our expansion and growth. Okay, I'm going to move on to the next one now, which is 1.5.2, and it says, explain with figures why one of the shareholders, N&I2, feels that the dividends she earns in Solar Style is not as good as the one she earns in NetGen. Oh, so there are two companies that we've been given now. Okay, so we have been given Solar Style as company number 1, and we have NetGen, which is company number 2. Let's start with Solar Style. Her DPS is 36 cents. The price that she has paid per share is 8.20 cents. And she owns 30,000 shares, which is the same as in NetGen. But in NetGen, she's getting 28 cents as a DPS. And the price that she has paid for her shares is 400 cents. So whenever we get to a situation like this, we are supposed to calculate now some call it the dividend yield, but I'm going to do it in a much simpler way. I just want to do it in a much simpler way. Let's try to do it in a much simpler way. Now, if we look at solar, let's look at solar. In solar, her DPS is 36 cents. All right? But she has paid 820 cents per share. She has paid, so you divide that now by what she has paid per share. So it's 36 cents, her DPS. Yet she has paid 820 cents per share. So what percentage of her share price is she getting in return as a dividend? What percentage of a share price that she has paid is she getting in return as a dividend? So we're going to now say, here is the calculation. 36 divided by 820. That is going to give us, let's multiply by 100. That will give us 4. Okay, 4.39. Okay, multiply by 100. That is going to give us 4. Let's say 4.4. Let's come to NetGen. In NetGen, she's getting 28 cents, whereas she has paid 400 cents per share. So what percentage is that? So it's 28. We divide that by 400. And we multiply by 100. Gives us 7%. Okay. Let's interpret these figures. When you come to solar, she is getting 4.4% of what she has paid per share as a dividend. But when you come to NetGen, she's getting 7% of what she has paid per share as a dividend. That simply means NetGen is giving her more dividends. She feels that the dividends she's getting in solar is not good. Yes, it is not good, because solar is only giving a 4.4% of what she paid per share as a dividend. Yet when you go to NetGen, NetGen is giving a 7% of what she paid per share in return as a dividend. So NetGen is giving a higher in return. Okay, so now we can explain why she feels that. But if you look at the figures, you see this is 36 and this is 28. You think solar is higher. No. NetGen is actually giving a higher return. Okay. Now, let's go on to the next point that we can look at. That if we compare the share price, in NetGen she paid 400. In NetGen, Anna paid. So in NetGen, Anna paid 400 cents. Anna paid 400 cents, which is lower than the 820 cents paid in solar. So you can see that in solar she has paid more or less double. When you go to solar, she has paid more or less double than what she paid in NetGen. Okay, so that is another point. All right, yet Anna only receives 36 cents in solar. She only receives 36 cents in solar and 28 cents in NetGen. So you can see she paid double in solar, yet she's not getting double as compared to NetGen. So you can see that when they paid more here, but the return is not double as well. So that is why she feels she earns, the dividend she earns in solar is not good. All right. Then I think we can end this one here, and then we take it again higher in our next lesson. So what I'm going to do now is I'm going to go on to my next activity, but I'm going to give you a quick 2-minute break before I start my activity number 2, which is from the free straight prelim for the year 2024. All right, so 2-minute break, and then I see you in 2 minutes. Welcome back, my good friends. We just went for a very short break and we did a very interesting activity one. That was such an interesting activity, and we looked at all the financial indicators from profitability, solvency, gearing, risk. We did all of that. And now we are coming to activity number two, which is extracted from the Free State Prelim for the year 2024. This one is so exciting, and the way it came, it was a bit different, and I liked it. And I hope that you guys have also had a look at it. Okay, so because of time, we're not going to finish it, but I'm going to allow you to do it over the week and possibly over the school break that we're going to have. And then in our next class, then we mark it together. Is that a good idea? Okay, that sounds great then. So I think we're going to do that. But nonetheless, let's see how far we can go. Maybe we can be able to answer at least one question so we can have a kickstart to this activity, activity two, which is from the Free State Prelim for the year 2024. Let's go. Okay, it says Cheetahs Limited and Stormers Limited. So here we have two companies now. So you see with the first one, we had one company, but here, right from the onset, we now have two companies. Number one is Cheetahs, and the second one is Stormers Ltd. The information relates to two companies. Background information. Both companies operate in the sports equipment. So in other words, we are comparing apples with apples. It's not apples with avocados or bananas. It's apples and apples. So they all operate in the sports and equipment industry. The financial year ends on the last day of February each year. Very key. Sophie Mona owns shares in both companies. Okay, so you remember in the previous one we had Enna we had companies in shares rather in the two companies. So here we now have Sophie who owns shares in both companies. Where financial indicators are required to support your answer, name the financial indicator. This is what we've been doing. Whenever you are dealing with financial indicators, you need the name of the financial indicator, debt equity ratio, return on total capital employed, asset test ratio. You need to give the name. The actual figures, 12%, 50%, 2 cents, 9 cents. Those are your figures. Or the ratio, 3:1, 2:1. And then the trends, increase, decrease, improved, deteriorated. That is very important. So the examiner is trying to tell you, if you are to get marks, give me name, give me figures, and give me trend. That has to be, no compromise there. Name, figures, trend. That has to go together. We cannot just analyze. We're not just going to write paragraphs. We must have the name, we must have the trend, and we must have the figures. And you need to comment as well. What do you think? What do you take out of this particular information? So to begin with, we're going to start with profitability. The directors of both companies tried to cut back on their expenses. Were they successful in their efforts? Quote two financial indicators for each company. So here we're given financial indicators. And what I did, I went to the question paper. There was a lot of financial indicators. So I only cut out the ones that pertain to this particular question. That's why you see 3. But when you look at your worksheet, you can see your worksheet is a bit different from what I have here because I've only extracted the 3. But on your worksheet, you have quite a number of them. Can you see that? Yes, but I only extracted the ones that I needed. So let's take these ones and go. Let's see. So if I am to talk on the profitability, there are specific financial indicators that I need to talk to. You need to know your profitability financial indicators right on your fingertips. The moment you look at the question, they say profitability, you must be able to spit them out just like that. So which one is the first one? Operating expenses on sales. So I'm going to come here and I'm going to say my percentage operating expenses on sales. So this financial indicator looks at the percentage of operating expenses as compared to sales. What percentage of sales is our operating expenses? All right. So for Cheetahs in 2024, it was 18.7%. And in 2023, it was 14.9. So you can see here, it has increased. Your operating expenses that is not a good situation. When your operating expenses are increasing, that's not a good situation. Let's go and look at Stormers. At Stormers in 2023, it was 17.5%, and it has decreased to 12.6%. So already I can see that we have two directors here who try to cut back on their expenses. But we can see that with Stormers, no. Stormers, they did not do a good job here. But with Cheaters, rather. With Cheaters, they did not do a good job. But with Stormers, yes. The operating expenses on sales has decreased from 17.5 to 12.6. I'm going to say it again. The directors of both companies tried to cut back on their expenses. If you come to Cheaters, it has increased from 14.9 to 18.7. So were they successful? No. And you come to Stormers, it has decreased from 17.5 to 12.6. Were they successful? Yes. Let's go to the next one now. Percentage operating profit on sales. Percentage operating profit on sales. What percentage of your sales is operating profit? Okay, so let's see now. Let's start with Cheaters again. It was 21.9, which was good, A high operating profit on sales. That means 21.9% of our sales was profit. That was good. And if we come to 2024, it has deteriorated now to 16.8%. Is that good? No. So here we are getting again a no. But let's go to Stormers and see with Stormers. In 2023, it was 21.6%. 21.6%. And in 2024, it was 24.7, 24.7. And you can see here, it has increased. Last year, the previous year, 2023, we had 21.6% of our sales being profit. And in 2024, we have 24.7% of our sales being profit. It has gone up. That means that is good. So that here we have a yes over there. Third one. Let's go to the third one. Net profit on sales. Percentage. Net profit on sales. Percentage. Net profit on sales. In 2023, it was 11.8%. So that means 11.8% of our sales, we recognized it as net profit. But in 2024, it declined, deteriorated to 8.9%. So 8.9% of our sales was profit now. It went down. Not a good situation. No. Let's go to Stormers. With Stormers, 13.3% of our net profit was sales. And in 2024, it went up. That's a good one. 15.9%. 15.9% of our sales was realized as profit. It went up. Is that a good thing? Yes, it is a good thing. Now, let's go and comment now. What do we say? With Cheaters, you can see we have three no's. No, no, no. Were the directors successful? We'll now say the directors were unsuccessful. The directors were unsuccessful. Okay? Because the percentage operating expenses on sales, the percentage operating expenses on sales increased. You see that? That is number one. Number two, the percentage operating profit on sales, operating profit on sales decreased. And thirdly, the percentage net profit on sales Percentage net profit on sales decreased as well. So, no, they were not successful. Not successful. Let's come to Stormers. In Stormers, were they successful? Yes. The directors were successful because the percentage operating expenses on sales decreased. Okay? That is number one. Point number two, the percentage operating profit on sales increased. Third and lastly, the percentage net profit on sales increased. That was a good thing. So this is how you were supposed to comment on this particular question. My good learners, we've come to the end of today's lesson. What an exciting lesson for me. And I hope that you enjoyed it as well. So let's do this one. I want you to go and finish off this activity. Yeah? Is it homework? Yes, it is homework. So I'm giving you a bit of work to go and do. Please finish this activity when we come back. When we come back in our next class, when is our next class? I'm going to quickly go. Our next class is going to be on the 9th of May. 9th of May, same time. 2:30 up to 4, I'll be here. And then we mark this activity together. It will be good if you've done it. Try it on your own so that it will make sense. It is always a joy and a pleasure to have you in my class. I look forward to seeing you on the 9th of May. Exactly 2:30, I'm here. Make sure you tell a friend to tell a friend that they bring all their friends to class. Until next time, enjoy your studies. Goodbye.